Okay, this is for you retirees out there. I want to talk about investment portfolios in retirement and specifically stocks and bonds and what's their relationship. A lot of people think bonds are going to protect you if stocks fall because there's this thing called an inverse relationship there, or supposedly. But I was just listening to this podcast. There's a fixed income analyst I want to, show you here, and you'll realize things aren't that simple anymore. I'll catch you on the other side
So,
here.
what's one thing you wish more advisors understood about fixed income and credit in portfolios?
Boy, there's a lot. One thing, I think we've grown up in a world where a correlation between equity and fixed income, equity and credit, was a given, and I think that's led to a lot of overconfidence. I think it's probably led to some risk being taken or put in places that it does not belong. Um, the assumption is for negative correlation, and that did break a few years ago. We're seeing that again. I don't think anyone's calling for it to be renewed or completely unwound. I just don't think it's as stable as we assumed it to be. So you can put together a bond portfolio that yields in the mid-single digits at 2/3 the expected return of equity. That's pretty good on the surface, right? Like, even without the expectation of it moving in an inverse way to equity, that's pretty good. And I think that we need to think about the purpose of this instrument in their portfolio, but also the number of roles it can play beyond just sitting there and trying to react to your equities.
Okay, so let's break this down a little bit. What he's saying is that for a long time, people thought bonds were like the safe part of portfolios. When stocks were to drop, bonds usually went up. That's that negative correlation that people thought would protect them. But that relationship has changed, especially over the last few years. In 2022 specifically, they both went down a lot. So, that's a tough thing to swallow. But if you're retired or close to it, this I think matters a lot because your portfolio really can't afford to take this unnecessary risk of actual correlation. But now bonds still play a very important role, a critical role in your portfolio. They can help, essentially produce some income in a portfolio or just reduce the volatility. But the simple strategy of having them there as a hedge or a um, negative correlation, I think has changed. And I think, why I wanted to jump on here, it's late at night to talk about this is I think you need to have an advisor who actually understands this and understands how these relationships in portfolios actually work. It's not about just being all in or all out. It's just knowing how to adjust your portfolios and what they're there for.